Have you ever looked at your investment portfolio, watched it grow, and quietly thought to yourself, if I just keep investing, compounding will take care of everything? Because honestly, I used to think exactly the same way. For years, every investing book, every financial expert, and almost every successful investor repeated the same advice. Stay invested. Ignore the noise. Time in the market beats timing the market. And you know what? Most of the time, they're absolutely right. Compounding is one of the greatest wealth-building tools ever discovered. It has created countless millionaires. It has helped ordinary people retire comfortably. And over the long run, the stock market has rewarded patience. But during the past few weeks, as I started digging deeper into today's market, reading research reports, studying historical crashes, and comparing today's numbers with previous market cycles, I realized something that honestly made me pause. Compounding works only if you survive the difficult years. That may sound obvious, but it's something many investors don't fully appreciate until they're living through a major market decline. History shows us that even great businesses and broad market indexes can lose 30, 40, or even 50% of their value, not because America suddenly stopped growing, but because investors became too optimistic. Prices became disconnected from reality, and eventually, the market corrected itself. I'm not saying that's exactly what's about to happen. No one knows the future, and anyone who claims they know exactly when the next crash will happen probably doesn't. But after looking carefully at today's data, I honestly believe the risks deserve much more attention than they're currently receiving. Over the last several months, I've spent hours reading market research, listening to earnings calls, comparing valuation metrics, and studying what some of Wall Street's biggest institutions are saying. What's interesting is that while television headlines continue celebrating new highs, many professional investors are becoming much more cautious, not because they think the economy is collapsing, but because they understand that markets don't move in straight lines forever. One statistic kept appearing again and again: the Shiller CAPE Ratio. If you've never heard of it, don't worry. I promise. It's much simpler than it sounds. Think of it as a way of measuring whether the overall stock market is becoming unusually expensive. Instead of looking at just 1 year's earnings, it compares prices with 10 years of inflation-adjusted profits. That gives us a much clearer picture of long-term valuation. Right now, that number sits around 40 to 41. And honestly, when I first saw it, I had to double-check the data, because historically, we've only seen valuations reach these kinds of levels a handful of times, most famously before the 1929 stock market crash and during the dot-com bubble around the year 2000. Now, that doesn't automatically mean a crash is coming tomorrow. Markets can stay expensive for much longer than anyone expects. But history also teaches us something equally important. When valuations become this stretched, future returns often become much lower, while downside risks increase dramatically. Then I looked beyond valuations, and another trend immediately stood out: artificial intelligence. There's no question, AI is transforming the world. I truly believe it will become one of the biggest technological revolutions of our lifetime. But something else caught my attention. Today, a very small group of companies, often called the Magnificent Seven, represents roughly 30 to 35% of the entire S&P 500. Think about that for a moment. Just a handful of companies are responsible for an enormous share of the market's recent gains. When I saw that, it reminded me of something history has shown us repeatedly. The stronger the concentration, the greater the risk if investor sentiment suddenly changes. And according to recent market commentary, several respected institutions, including analysts at Bank of America, JP Morgan, and independent research firms, have also started highlighting some of these same concerns, not because they're predicting the end of the world, but because they recognize that today's market is becoming increasingly dependent on continued perfection, perfect earnings, perfect AI growth, perfect economic conditions, and perfect investor confidence. The problem is, markets rarely stay perfect for very long. So the question isn't whether compounding works. It absolutely does. The real question is, will your portfolio be prepared if the road becomes much rougher than most investors expect? Because sometimes protecting your investments is just as important as growing them. And that's exactly what I want to talk about next. The more I researched this market, the more I realized this isn't just a story about expensive stocks. It's really a story about expectations. And today, those expectations are incredibly high. Let's start with artificial intelligence. I want to make something very clear. I am not against AI. In fact, I believe AI will completely transform industries over the next decade. Healthcare, finance, education, manufacturing, almost every business will be influenced by artificial intelligence. That's why companies are investing hundreds of billions of dollars into data centers, AI chips, cloud infrastructure, and energy. Companies like Microsoft, Amazon, Meta, and Alphabet are spending at levels we've never seen before. When I first looked at those numbers, I thought, this is incredible. But then another question came into my mind. What if investors are expecting profits much faster than reality can deliver? Because building amazing technology and making enormous profits from it are two very different things. History has taught us that revolutionary technology doesn't always create revolutionary investment returns, at least not immediately. Think back to the internet boom. The internet changed the world. Nobody can deny that. But during the year 2000, many investors paid prices that businesses simply couldn't justify. The technology survived, the excitement didn't, and millions of investors lost enormous amounts of money simply because expectations had become unrealistic. As I compared today's market with previous cycles, I noticed several similarities. Again, history never repeats itself perfectly, but it often rhymes. One thing that stood out was market concentration. Today, the Magnificent Seven represent roughly 30 to 35% of the entire S&P 500. Just think about that. A handful of companies are carrying a massive portion of America's biggest stock index. That creates opportunity, but it also creates risk, because if even one or two of those companies disappoint investors, the impact spreads across the entire market. That's exactly why several analysts, including researchers at JP Morgan, have warned that crowded trades can sometimes create very sharp corrections, not because businesses suddenly become terrible, but because everyone tries to exit at the same time. And honestly, that makes sense. Markets don't move only because of earnings. They move because of human emotions, fear, greed, optimism, and disappointment. Sometimes, those emotions become stronger than the fundamentals themselves. Then I came across another interesting report. Bank of America strategist Paul Sienna recently discussed the possibility of a three-wave correction, often called an ABC correction. Now, technical analysis isn't perfect. No indicator is. But what caught my attention wasn't the prediction itself. It was the reasoning behind it. Diverging momentum, extremely bullish positioning, and signs that investors may be becoming a little too comfortable. That doesn't guarantee a correction, but it does suggest that risk is increasing. Another research firm, the Luthold Group, reached a similar conclusion, using a completely different approach. Instead of studying charts, they looked at valuations. Their analysis suggested that if the market eventually returns toward long-term historical averages, the downside could become much larger than most investors currently expect. Again, that doesn't mean a 40% decline is inevitable. It simply reminds us how expensive today's market has become. Then I started looking at investor behavior. And honestly, this may have concerned me more than anything else. Retail investors continue buying aggressively. Social media is full of people convinced that stocks only move higher. Fear of missing out, or FOMO, seems stronger than ever. Margin debt remains elevated. Many insiders have been selling far more shares than they're buying. And historically, extreme optimism has rarely been a healthy sign. When everyone believes risk has disappeared, that's usually when risk is quietly growing. Even with strong corporate earnings, there's another challenge: valuations. Companies can deliver excellent results, but if investors already expected perfection, even great earnings may not be enough. Markets don't simply reward good companies. They reward companies that exceed expectations, and that's becoming increasingly difficult, especially when expectations are already so high. Now, does this mean you should sell everything? Absolutely not. That's not what I'm saying, because nobody can consistently predict the exact top. What I am saying is that today's market looks very different from just a few years ago. Higher valuations, greater concentration, more speculation, and much bigger expectations. Those factors alone don't create crashes, but when combined with unexpected economic news, policy changes, or weaker earnings, they can become the spark that starts something much bigger. And that's exactly why the smartest investors don't prepare after markets fall. They prepare before uncertainty arrives, because protecting wealth is often the first step toward building more of it. So, after spending weeks reading research, listening to earnings calls, and comparing today's market with previous cycles, I eventually asked myself, what should I actually do? Because learning about market risks is one thing. Acting wisely is something completely different. And honestly, I don't believe the goal is to predict the next crash. The goal is to prepare without becoming emotional. One thing that really caught my attention was the condition of the American consumer. For years, consumer spending has been one of the biggest engines driving the U.S. economy. But recently, several warning signs have started appearing. Many families have already spent most of the savings they built during the pandemic. Credit card debt has climbed to record levels. Interest payments are becoming more expensive, and consumer confidence has started showing signs of weakness. Now, does that mean a recession is guaranteed? No, absolutely not. But it does remind us that consumers can't keep spending forever if borrowing costs remain high. Another challenge is inflation. Although inflation has cooled compared to previous years, it hasn't completely disappeared. Oil prices remain unpredictable. Geopolitical tensions continue creating uncertainty, and the Federal Reserve still faces a very difficult balancing act. If interest rates stay high for longer, economic growth could slow. But if rates are cut too quickly, inflation could return. Neither situation creates an easy environment for expensive stock markets. Then there's corporate earnings. On paper, many companies are still delivering strong results. Some analysts expect S&P 500 earnings growth to remain healthy. But here's something I've learned over time. Markets don't only care about good earnings. They care about expectations. When expectations become extremely high, even excellent results can disappoint investors. That's exactly why valuation matters. So, what are experienced investors doing? This was probably the most valuable lesson I learned. Most professional investors aren't running away from the stock market. They're preparing. They're becoming more selective, more patient, and more diversified. Some are gradually increasing cash positions. Others are adding short-term treasury bills or high-quality bonds, not because they expect the world to end, but because they want flexibility. If great companies suddenly become much cheaper, they'll have cash ready to invest. That idea really changed the way I think. Instead of asking, how much money can I make today? I started asking, will I be ready when the biggest opportunities arrive? Because history shows the best investments are often made during periods when everyone else is afraid. My 5-step emergency plan. If you're feeling uncertain, here's the simple framework I'm personally following. Step 1. Don't panic. Fear has destroyed more investment portfolios than market crashes ever have. The biggest mistake is selling quality investments simply because prices have fallen. Remember, price and value are not always the same thing. Step 2. Keep dollar cost averaging. If you're investing for the long term, continue investing regularly, because nobody can consistently predict the perfect bottom. Buying gradually removes emotion from investing. Step 3. Reduce concentration risk. Ask yourself, what percentage of your portfolio depends on just a few technology companies? If one sector controls too much of your future, it may be time to diversify, not because technology is bad, but because Diversification protects you from unexpected surprises. Step 4. Build financial flexibility. Many analysts recommend keeping 10 to 20% of your portfolio in cash or short-term treasury securities. Think of this as opportunity money, not fear money. If markets decline, you'll be ready instead of wishing you had cash available. Step 5. Focus on quality. When markets become uncertain, quality matters more than excitement. Look for businesses with strong cash flow, healthy balance sheets, reliable management, and durable competitive advantages. Companies that can survive difficult economic periods, because eventually markets recover. Weak businesses sometimes don't. My personal perspective. So, am I predicting a market crash? No, I'm not. Nobody knows exactly what tomorrow brings. The market could continue climbing for months, maybe even longer. But based on everything I've researched, I also believe ignoring today's risks would be a mistake. For me, this isn't about fear. It's about preparation. I would rather prepare for something that never happens than be completely unprepared if it does. Because here's something history has taught us. Every single market crash eventually ended. Every bear market eventually recovered. And every major correction created opportunities for investors who remained patient and emotionally disciplined. That's the real power of compounding. It isn't just leaving your money invested. It's having the confidence to stay invested even when everyone else is panicking. Compounding doesn't reward perfect market timing. It rewards consistency, patience, and discipline. So, if today's analysis made you think differently, I'd love to hear your opinion. Do you believe the market is becoming too expensive? Or do you think artificial intelligence will continue pushing stocks higher? Share your thoughts in the comments below. I genuinely enjoy reading different perspectives because investing isn't about proving who's right. It's about continuing to learn. If you found this video helpful, please consider liking the video, subscribing, and turning on notifications, because every week we'll continue exploring real market data, long-term investing strategies, and practical ways to build wealth without the hype. Thank you for spending your time with me today. Stay patient, stay prepared, keep learning, and remember, the investors who succeed aren't always the smartest. They're usually the ones who stay calm when everyone else loses theirs. I'll see you in the next video. Take care.